Hey everybody, welcome to my Financial Friday live broadcast. It's been a bit of a summer for me, so I missed a couple of weeks. So I appreciate you forgiving me for missing my consistency the last couple of weeks. But I'm back and I'm ready to rock. So today we're going to have a topic I've actually been asked a lot about recently, and it's interesting because there's a lot of reasons why I think I might have been asked about it, and it comes from a couple of different directions, and I'll get into that in just a second. But first of all, every single Friday, with the exception of the last couple, we're here giving you a topic that we think is valuable to you, whether it be mortgage related, whether it be just related to your finances. Last year, we did a series of financial topics you should have learned in school. So check out my YouTube library for those, because we really want to help guide you through financial needs and what's going on in your life. So as you watch today and any of my videos, please make it as interactive as possible. Join the chat, plug in comments that you have. If you're watching live, then those comments will show up immediately and I can respond to them immediately. If you're watching recorded, no big deal. I'll get to those. They'll pop up and I'll follow up with you afterwards. So what is the topic today? The topic is it possible to buy a home after a bankruptcy? And that's a question I've been asked a lot recently is, John, what are the rules for buying a home after a bankruptcy? Now, I think that part of that is we've got people who've had bankruptcies in the past and they're saying, hey, my bankruptcy, I got a home or a bankruptcy on my credit report from 10 years ago. And I'm not sure if I can buy a home. Is that going to stop me from buying a home? Some people have bankruptcies that are way more recent, and they're concerned about, hey, I know I can't buy a home right after a bankruptcy, but what's my deadline to get back into home ownership? But here's the other side of what I'm wondering. I'm wondering how many people right now are contemplating bankruptcy today. And I think that's a large part of where some of this is coming from is people. I've got clients who are looking to purchase a home, and they've been looking for the last couple of years. The interest rates have gone up. The house prices have gone up and then kind of stabilized in the last year. Yet inflation and the cost of living has continued to go up. The rent has continued to go up. And a statistic, and I don't know the exact number, but I know that consumer debt, which is credit cards, car payments, student loans, have exploded, especially credit cards, in the last few years. Let's make matters worse. The actual interest you're paying on those credit cards have exploded as well, because most credit cards are tied to the prime rate, which is what the Federal Reserve controls. And so your credit card rates have gone up by 5.5% in the last 12 months. That's huge. That's taking an average credit card from 22% to 27.5% interest. And it's becoming quite an avalanche of debt on people. And we're seeing bankruptcy filings starting to tick up. That's part of the reality of the economy that we're in right now. The Fed's talking about a soft landing and being able to not go into a recession, but there's a lot of people who have stretched a little bit too thin with inflation and high rents, and it's creating a challenge that is coming to bite them. So the first thing I actually want to talk about is bankruptcy the right option for you? So if you're in a challenging situation and you're saying, you know what, maybe I should do a bankruptcy, let me talk through some of your alternatives. Now, I'll tell you that the benefits of a bankruptcy, by the way, not a bankruptcy attorney, don't know bankruptcy law. I'm just speaking from a credit perspective and from a long-term being able to finance a home perspective. Bankruptcy is pressing the reset button. So you're slamming the brakes and you are paying back, you're not paying back, you're eliminating the debt that you owe. Now, there's two types of bankruptcies. There is a Chapter 7 and a Chapter 13. Now, you might hear like a Chapter 11. That's a business bankruptcy. So for a consumer, the two types of bankruptcies that you're going to be dealing with as a household or as an individual doing a bankruptcy is a Chapter 7 and a Chapter 13. The difference is pretty simple. A chapter 7 says, I'm washing my hands of the debt. I don't owe you anything, likely because you're what's called insolvent. Insolvency means that you have more debts than you do assets. So your balance sheet is upside down. If you sold everything that you owned right now, you couldn't pay back everything that you owe. Usually that's one of the things that comes into the calculation of, can I do a chapter 7 and just wash my hands of it? How much do you have in assets? What's your income? Lots of things that are looked at. The opposite is a chapter 13. A chapter 13 says, okay, we are restructuring your debt and we are kind of a consolidation, but not a consolidation. I'll talk in a minute about what it really looks like. So with a chapter 13, you are looking at essentially the bankruptcy court says, fine, all of your creditors come in and they file a petition that says, hey, this is how much money is owed to me. And the bankruptcy court decides, okay, you've got to pay this person this much money and these people this much money. And we're going to set a schedule of how much you need to pay every single month. And we're going to set a schedule for how long you have to pay it. And you start making payments. And what happens is you pay the money to the bankruptcy trustee. The trustee turns around and pays small bits to each of the creditors that you're owed. Now, the creditors no longer charge interest. They're just receiving installment payments to get back the money that you owed, or a portion thereof, a portion of the money that you owed at the time that you filed the bankruptcy. So you're paying pure principal. You're not paying any interest when you do a chapter 13. You do pay some fees to the trustee for processing the paperwork, etc. But the benefit of a chapter 13 is the debt is eliminated at the end and you're not paying interest anymore, but you still pay back a majority of the debt. The chapter 7, you don't pay back any of the debt. It's just gone. Okay. So the key about filing a bankruptcy is really to think, at least from my side, from the mortgage bank home ownership side, is first of all, if you already own a home. If you own a home, a bankruptcy does not mean you have to sell your home. A bankruptcy just means that the house itself, you can still make the monthly payments on. The mortgage loan just disappears off your credit report. I won't bore you with the details of why. But the bottom line is that when you file bankruptcy, you can keep your home, but it makes it harder to get a new home loan later. And that's what we're going to talk about in a few minutes, is the different ways you can get a new home loan, because you're in the penalty box. There's a waiting period after bankruptcies, depending upon the type of new loan that you're doing at the time that you try and take out that new loan. So really what we're talking about here is, John, what can I do if I don't want to do a bankruptcy? Well, one of the things you can do is do a consolidation loan. If you have good enough credit, you can maybe consolidate it into just a fixed monthly payment. You put all your debts together into one loan and you make a monthly payment on it. Another option you might want to look at is doing a cash out refinance on your home. Now, cash out refinances are an important step that isn't taken lightly, because you're using up some of the equity in your home. And the truth is, you owe the money no matter what. I'm not advising you're taking on extra debt. You're just moving the debt, but it makes it tax deductible because now it's mortgage interest. And the interest rate overall is likely lower than what your average rate is between your 3% mortgage and your 27% credit card debt. The other thing is, a lot of people might look at, hey, John, I'll take a home equity loan or line of credit. That's an option. That's an alternative to a bankruptcy. The problem is that home equity loans and lines of credit, those interest rates have almost doubled in the last year, because those were running 4% on average a year ago, but rates have gone up by 5.5% for the prime rate. So you're looking at essentially interest rates that are in the 9%, sometimes 10% range. That's a huge difference in monthly payment. And so you're going to be putting yourself in a position where you're going to owe so much money on that home equity loan or line of credit and interest that it might have been better to put everything into one loan at a 7% interest rate instead of having the two separate loans. But here's another thing. Be very, 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 very cautious of debt companies that help you eliminate your debt elimination programs, because they ruin your credit. The cool thing about a bankruptcy is it puts you in the negative is it puts you in the penalty box. You can't do a loan for a certain period of time. But a bankruptcy doesn't hurt your credit that bad if you filed the bankruptcy without having a lot of late payments. So the key is timing. If you can actually time your bankruptcy filing where, hey, you're robbing Peter to pay Paul, things are getting really tight, you know that you're not going to be able to solve this problem, but you haven't been significantly late, your credit score actually gets preserved to some degree. It takes a hit because of the bankruptcy, but it recovers pretty quickly. So you maintain a good credit score by filing a bankruptcy quickly when you know you don't have any other option. A debt elimination program is the exact opposite. What they do is they tell you, hey, you don't have to file bankruptcy, and we do exactly the same thing as a Chapter 13 does. You just make us payments every month, and we hold on to that, and then we negotiate with your creditor, and we pay them in chunks out of the money that you've been paying us. All of that is true. The problem is that they are ruining your credit in the meantime, because what they tell you to do is to, hey, stop paying those other people. Now, if you stop paying because you filed bankruptcy, they're legally not allowed to report that you're not paying on your credit report. They're not allowed to report anything on your credit report because bankruptcy protects your credit. But these debt elimination companies, they let those accounts go into collections. They let them get charged off, which is a huge hit to your credit score. So now your credit score falls significantly because all these accounts are in charge-off status. And then you turn around and they'll negotiate. Hey, I owed 10 grand on this credit card, and they're going to accept $4,000. Well, the reason they're accepting $4,000 is because they haven't gotten a penny from you in a year, and your credit's been ruined all along the way. So do not fall for those programs because they are not what you think they are. And even though you're making payments, you think, well, how can I be late? I'm making a payment every single month. I'm just paying it to this company. They are not sending your money every month to those other companies. They're choking off your creditors and not giving them a penny of the money you're paying. They get to hold your money and earn interest on it. And then periodically they'll negotiate and write a lump sum check to pay them down. And they get to keep a portion of the monthly payment as their service charge. So be careful about those bankruptcy alternative programs because they are not what they're cut out to be. And I'm not saying bankruptcy is a good idea. I think there's a lot of ways to avoid a bankruptcy, but I also think that a bankruptcy is a great reset button. If you are too far underwater and things are in bad shape, you need to press the reset button. And when you press that reset button, you get a clean slate. Okay. You're not given as much autonomy as you were before. But here's the funny thing. The funny thing is you actually have an easier time getting credit right after a bankruptcy because those credit card companies know you're not able to file for another bankruptcy right away. So the chances of them losing money are slim. But the mortgage world and the credit world, we're paying really close attention. If you start making late payments on credit cards after the bankruptcy, you haven't learned your lesson, which means your credit score tanks even more. And we are super concerned about trusting you to buy a home after you filed for bankruptcy. So everything I'm about to talk about in this webinar about how to buy a home after a bankruptcy is predicated on you've got to make sure that you have good payment history. Make sure you have good payment history on all the new debt. And yes, you have to open new debt. Because if you file bankruptcy and you say, I'm not gonna make that mistake again, and the outcome is you say, I'm never, ever gonna use credit again because credit is evil. Well, problem is then I'm not gonna be the first person you test yourself out on. I'm going to say you haven't reestablished credit after the bankruptcy. And you're like, yeah, because I didn't want to get in trouble. Then how do I know that you're gonna not get in trouble with the mortgage? I don't have that ability to trust you. And so I've got to have you reestablish your credit, rebuild your credit after the bankruptcy is critical. So open credit, use credit. The rates are going to be astronomical. The annual fees are going to be crazy. A lot of them have monthly fees they're going to charge you because, look, you filed bankruptcy. You don't have a lot of options. Pay the piper. Get a credit card and use it, keeping your balance between 10 and 25% of the credit limit. By doing that, you're going to be able to reestablish credit, and that's critical to being able to purchase a home and rebuild your credit after a bankruptcy. All right, so let's move on to what you really came for, which is how to buy a home after a bankruptcy. So the key thing that we have to first pay attention to is what type of bankruptcy you did. So the Chapter 7 is there's a filing date that says, hey, I think I'm in trouble and I need to file a bankruptcy. And then you go to court and they talk to your creditors and they take a look at how much you have in assets versus how much you have in debts. And the judge decides, are you approved for the bankruptcy? If you are approved, the date it becomes approved is really what's called the discharge date, meaning all the debts have been wiped clean, you've been discharged. So you've got the filing date and you have the discharge date on a Chapter 7. There is technically a dismissal date too, where you can say, hey, you don't qualify for the bankruptcy and it's been dismissed. But you kind of already showed your hand because you already said, hey, I can't pay my bills, I'm in bankruptcy. So your bankruptcy counts even if it was never discharged. So you got to be careful about that piece. So you're looking at on a Chapter 7, we're basing our timeline, your penalty box, your waiting period is based upon the date it was discharged, not the date it was filed. And there's times when it takes a long time to get through the courts. Maybe you weren't providing the paperwork to your attorney in a timely manner. Lots of reasons why a Chapter 7 can be a long time between filing and discharge, but it is the discharge date that we care about, not the filing date. Okay, that's critical. So you do want to expedite the process as much as you can if you feel the bankruptcy is the right thing for you. For a Chapter 13, a Chapter 13 is where you are making monthly payments. So the bankruptcy is actually not discharged until you're done making all of your monthly payments. So you might say, hey, John, I have a bankruptcy that I did back in 2017, but you were on a 5-year payment plan for the Chapter 13, which means you didn't finish paying until 2022. In the eyes of the mortgage world, that is a 1-year-old bankruptcy because we're in 2023 and it was a Chapter 13 that was discharged in 2022. Now, there's a couple of exceptions to that rule, and I'll cover those exceptions as I go forward. But in general, a Chapter 13 is based upon the discharge date, and it's kind of frustrating because you might have been making payments for 5 years, but it wasn't until, or 3 years or whatever it is, but it wasn't until you were done making payments and they said, okay, you've paid everybody back what we expected you to, and now your bankruptcy's been discharged. That's when the actual clock starts for many loan programs. So let's talk about the clock. Well, first of all, the clock depends on what type of loan you're doing. Now, what do you mean by what type of loan, John? It really is 4 types of loans. A conventional loan. Conventional loans are backed by Fannie Mae or Freddie Mac. Or is it an FHA loan? Again, different type of rules because FHA looks at things different. Could it be a VA loan if you're a veteran of the U.S. military? Quick hint, VA loans are the most forgiving. So they typically have the shortest waiting period of any loan program. Or it's a USDA loan. USDA is the United States Department, and USDA loans money to people buying in rural communities. So you're not buying in a big city. There's a map that I can show you. I've got a video on my YouTube channel on USDA financing. So go to my YouTube channel and search USDA. And I've got, probably a 45-minute to an hour-long video, everything you need to know about USDA financing. USDA is an option. The 5th option is a jumbo loan. And the 6th option is what's called a non-QM loan. Now, jumbo loans are for people with great credit that are buying a house that has a loan amount greater than the conventional limits for that county. Across the country in 2023, that limit is $726,000, although in some high-priced areas like the San Francisco Bay Area, it's over $1 million that you can borrow on a conventional loan. Once you go over that, it's jumbo. Most jumbo loans have super strict guidelines. Some of them say you can't have a bankruptcy in your history ever. Some say it can't be 7 years. It has to be at least 7 years. So I'm not going to go into the specifics on jumbo loan timelines because they're all different depending upon the bank that I use to access the money for you. And there's varying degrees of forgiveness, but with forgiveness comes higher interest rates and higher fees and higher monthly payments. So be aware, all of that is a trade-off. So let's dive into what are the waiting periods. So first of all, if you're doing a conventional loan, you can do a conventional loan with as little as 3% down. So this, and by the way, there are down payment assistance programs that use conventional loans. So when you say, well, John, you talked about all this stuff, but how about down payment assistance programs? Where do those fit in? They actually fit into each one of these guidelines. Most down payment assistance programs use a conventional option and potentially an FHA option and potentially a VA or USDA option. So it's within the down payment assistance program that we are looking at what type of base loan are we doing. So for example, Cal HFA, for their Dream for All program, for the My Home program, for the ZIP program, Cal HFA uses Fannie Mae conventional loans as well as FHA loans, okay? So what are you looking at for timelines? We'd be looking at the same timelines that I'm about to talk about for conventional loans and FHA loans. The GSFA Platinum program uses Freddie Mac conventional loans and FHA and VA loans. And by the way, I think both of those also offer USDA. So it's not about what type of down payment assistance you're using. It's about what base program are we using with that down payment assistance program. Hopefully that makes sense. So a conventional loan, if you have a Chapter 7, which means you wiped your hands of the debt, you can't get a new home until 4 years after the discharge date. So remember, Chapter 7 is discharged pretty quickly, but you've got to wait 4 years. Now, there is something called extenuating circumstances. And sometimes these waiting periods can be shortened due to extenuating circumstances. And so I want you to understand for a moment, let me pull up, I have a banner on this. Sorry. Okay, so I want you to think about what is an extenuating circumstance. Extenuating circumstances are when something happened that was clearly outside of your control. And if we can prove that, we can shorten the timelines in some of these situations. Now, I'm not going to go through what the timelines are for extenuating circumstances because they vary. And extenuating circumstances are very, 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 very hard to prove. It had to be something that wasn't within your control. Now, let me give you some examples of extenuating circumstances. If you are married and you are a stay-at-home parent, or maybe you both work, but your spouse was the primary breadwinner and your spouse unexpectedly passes away or is disabled or has a major accident. That wasn't your choice. Nobody planned for that. Nobody could have made better life decisions to not have that happen. That was an unexpected event or extenuating circumstances. The challenge is we've got to prove that things were good before that event, and they got bad because of that event. So if you had challenges with your credit before the extenuating circumstance event, we might not be able to prove that it was extenuating circumstances, even though you had a major event, a job loss, a death of a wage earner. Any number of things can cause a extenuating circumstances event, but we have to be able to prove the timeline that said everything was good, this event happened, and everything went bad. Okay, so the challenge is sometimes things don't go bad for a while. Sometimes you stretch it along and try and figure out how to keep things together. Maybe it's 2 years after the major event before you realize, man, I was borrowing on my credit cards to pay for my house payment, but I stretched it out for 2 years, and then the house of cards fell apart. Well, the challenge is that we can't really see a direct correlation between cause and effect. We can't see a direct link between, hey, I had this life event, and then right after that, I had to file for bankruptcy. There's no timeline, but it's got to be pretty clear that the credit issue started right after that event. Now, let me give you an example of what's not an extenuating circumstance. Divorce. A lot of people say, you know what, John, I got divorced. That wasn't my fault. Therefore, it's an extenuating circumstance because, my spouse, stopped paying their portion of the bills, whatever it happens to be. The mortgage world doesn't see it that way. The truth is, my opinion is the mortgage world says marriage was a choice, divorce is a choice, the debt you incurred during the marriage is a choice. And so it isn't extenuating circumstances. You had choices there, and they're not going to allow you to treat a bankruptcy as an extenuating circumstance simply because it was caused by divorce. That is by the way, the opposite of extenuating circumstances is financial mismanagement. Hey, I bought too many toys. I bought jet skis and boats and cars and took nice vacations and DoorDashed every single day. That's financial mismanagement. If you don't have the money to pay for those things, you shouldn't do it. No matter if your neighbors and your sister and everybody you know are doing all of those things, that's a choice whether you choose to do that or not. So extenuating circumstances can shorten these waiting periods, but the reality is it's very, 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 very hard to prove both the extenuating circumstance and make the correlation between the extenuating circumstance and the actual bankruptcy. All right, so we talked about conventional loans are 4 years from the Chapter 7 discharge date. The nice thing is that they're only 2 years from a Chapter 13 discharge. Now, if you dismissed your Chapter 13, you got to wait 4 years from the dismissal date. But if you actually finished paying your payments from the date that you finished paying your payments and it was discharged on a Chapter 13, you only have to wait 2 years on a conventional loan. Now, there's some better options, some shorter options that we're going to get into. So FHA is more forgiving. FHA says 2 years on everything. We're cool. As a matter of fact, so you're 2 years after the discharge date on a Chapter 7, 2 years after the discharge date on a Chapter 13, which is when you finished making payments and you discharged. But FHA has a super cool rule. FHA says, hey, if you're in the middle of making payments on a Chapter 13, then as long as you've been making payments for a year and I can prove that those payments have been made on time, I don't need the bankruptcy to be discharged. You can actually buy a home. You can actually do a loan while you're in the bankruptcy. You just have to have trustee approval. The person who is appointed by the court to be in charge of receiving your payments and dispersing your funds, they have to approve you getting this home. And as long as they do, then you can buy a home while you're still in a bankruptcy using FHA. Now, the key is, how's your credit? Because if you filed bankruptcy early enough, you've salvaged your credit by not having a lot of late payments. If you stretched it out and waited until the last possible minute and you're behind on everything, even though you've made good payments in the last 12 months on the bankruptcy itself, the fact is your credit has been destroyed and you're not going to meet the minimum credit score. So it's really important to understand the timing of that and how that's going to be impacted for your ability to purchase a home in the future. All right, so remember, FHA, we can do it with 1 year after the bankruptcy. 1 year after you started making payments on a Chapter 13. You don't even have to be done making those payments on the Chapter 13. All right, now let's go on a little bit further here, and let's look at VA. So VA loans are loans that are backed by the Veterans Administration. And I told you VA is pretty forgiving. So VA is just like FHA on a Chapter 7. VA says 1 year after the bankruptcy is all that you need. And so VA is pretty forgiving. 2 years. VA says 2 years after a Chapter 7. Hold on 1 second here. VA says 2 years after a Chapter 7 bankruptcy. But on a Chapter 13, VA goes even one step further than FHA. VA says, hey, if you finished making your payments and it's been discharged, you're good the day after. Like, you don't, 0 time after discharge on a Chapter 13. You simply need to make, as long as you made all the payments and it's been discharged, a VA loan says you're fine on a Chapter 13 immediately. You also can do, like FHA, you can do a VA loan with a Chapter 13 after 12 months of on-time payments. So you've got some flexibility there that even while you're in the middle of the bankruptcy, VA will allow you to do the loan with a shorter amount of time on the bankruptcy without having it being discharged. So 12 months is okay of payment history, even when you're in the middle of the Chapter 13, as long as the attorney gives you approval. All right. So The last one I want to talk about is USDA. So USDA is cool. It's got 0 down payment required. USDA requires more time than FHA. It's a 3-year waiting period on a Chapter 7. But here's the deal. USDA only requires 1 year on a Chapter 13. So as you can see, there's a lot of options here. There's a lot of creative ways to make it work. What you have to do is you have to set up an appointment to talk to me to figure out, John, what are my options? How can I make this work? And really, what are my next steps? Okay. So what I want you to think about is, what is my game plan? Where do I want to be down the road? Whether you filed a bankruptcy and you're trying to get a game plan for when I can buy later, or whether you're thinking about filing a bankruptcy, it's a good idea to set up a consultation with me, because I'll walk you through. I won't advise you on whether you should get the bankruptcy or not, but I'll listen to what your options are and what you're thinking of doing. And I will give you advice on what that's going to mean to your ability to qualify in the future. Really, really important to understand going in eyes wide open what your options are now. But the most important caveat I have is that these rules can change at any time. And it's based upon the rules at the time that you take out the loan. So if I said right now, hey, you can do an FHA loan 2 years after a bankruptcy, and so you file your bankruptcy right now, and then in a year and a half, FHA changes the rules and say they want 4 years after the bankruptcy. Well, unfortunately, you've got to wait then, because you weren't at that 2-year mark and you didn't buy the home. And you now, when you are at the 2-year mark, they've changed the finish line. Super frustrating. It hasn't happened in a long time. I don't think it's going to happen, but I need to be super clear. It can happen. And so I don't want you to be stuck in a position where you're frustrated because, oh my gosh, John, I made plans on what I was going to do regarding my debt. I made the decision to file or not file a bankruptcy based on those rules that you told me. Well, we have to make decisions based on the best information we have at the time. And so what I'm providing you right now is accurate information based on July of 2023. If you're watching this at any point down the road, double check with me. Put a comment into the comment section of whatever platform you're watching this on and say, hey, John, is that still the rule? What's the rule on FHA? I'm happy to help advise you and guide you through the process. So if you have any questions right now and you're watching live, feel free to post. If you're watching recorded, feel free to post questions at any point in time. And please check out my YouTube library, because I've got a lot of good information to help you figure out what your options are on lots of different financial situations. So if you're ready to start your homeownership journey, right over here, you're going to see Scan Me. See, Scan Me. So you're going to go to johnloneking.com or click on that QR code. Also, check me out on YouTube. I put a lot of video content out on YouTube, and I really appreciate you subscribing to my channel. Liking and sharing the information is critical to my ability to get my message out there to as many people as possible. So thank you so much for joining me today. Hope everybody has an amazing weekend, and we'll look forward to talking to y'all soon. Bye-bye.